Mortgage loans. What lender do you frickin' use, for crying out loud? I mean, aren't all the banks the same, right? Are they the same? Hell no, they're not the same. The only thing that's the same is 30-year money. 30-year money is pretty much the same no matter where you go. It's not a big secret. You can go to Chase, you can go to Wells Fargo, you can go to US Bank, you can go to any of them. You know, their costs are going to be a little different. The rate difference is going to be somewhere between a 1/16 of a percentage point, maybe a quarter, if they change earlier than the next one. Some of them change rates throughout the day, you know, and are really on top of the 30-year of the bond. As the bond changes, the 30-year mortgage rates change. What about the other banks that are out there, or the other types of mortgage lenders out there? What about the lenders that the brokers go to? Are they so much different? Yeah, they are. Sometimes they're more expensive to do those loans, but the overall outcome of those particular mortgages are: one, they close way faster; two, you get very personal business, one-on-one connections with not only the originator, real time, but also sometimes the underwriter or processors. You can pick up the phone and call them. You take your loan to Chase and it has gone to the East Coast somewhere, and you know the chances of you chasing that down are just slim to none. And I don't mean to put down Chase or some of the other institutional banks, but they have a tendency to bury your stuff. And if you make one mistake, if you don't get something in time, or if there's a page missing in your bank statements, you know, or you just don't have an exhibit that's quite right, oh my God, talk about delays. Shit. With a broker, you can recover much faster. You know, those are some of the things that I know, right? The other thing is there's some other brokers out there that are selling to specific lenders that have really cool products. CMG being one of them. CMG has this product where you deposit your paycheck into an account, right? And whatever balance is on that account includes your mortgage, right? Well, while that paycheck is sitting on your account, and before you spend it, let's say you keep that paycheck on your account till the 20th. And then from the 20th to the 30th, you pay your bills. Well, from the 1st to the 20th, it draws down the mortgage balance because that money is applied to the mortgage balance during that particular time. And because interest rate is accumulated on a daily basis and not monthly basis like the 30-year, you've drawn down the interest for that particular time. You don't pay any more to the mortgage than you normally would on a regular mortgage. At the end of the month, they automatically take out the mortgage payment, but then you do it all over again. You draw it down. You always have the money in there, just like a bank account. They give you an ATM card. You know, your interest rates are way low compared to a 30-year. But, you know, again, I'm just trying to give you an example of other types of mortgages out there. Back before 08, there were so many different types of mortgage. I mean, a lot of them got a bad rap, but there was a cozy arm, the coffee arm, the MTA, the LIBOR index, the Treasury index. I mean, there was all kinds of indices that we were able to ride under, and they all operated a little different. I loved the LIBOR, the London Interbank Offering Rate. Was an awesome index, and all my mortgages were always on that. I used the 6 months. The 6 months went down to like 0.12%. Remember, the 30-year, for the first 5 years, you're not going to pay any more. I mean, you're going to be at 97% of that loan. Hardly any of it goes to principal, honestly. You don't start paying down the principal until about the 18th year. Who's going to be in that mortgage for 18 years? Probably not you, because if your house doubles in value, you're going to take the cash out and put it into another investment, right? Right. That's what people do. They refinance. That's why there are refinances. Everybody that refinances, by the way, starts over on a new 30-year amortization schedule. Pull up an amortization schedule and look at it, and man, you're not going to like what you see. In fact, it's kind of discouraging. It might even discourage you from doing a mortgage. But there's other loans out there, and there's ways to pull that down, which I can show you how to pull down that principal. If you do an ARM and then you pull the difference down between the ARM rate and the 30-year, understanding that you have about $120 or $200 more cash flow going on. Take that $200 and throw it back into your principal. Now you've pulled that principal down. Now you're paying the house off in 18 years instead of 30. Try it. Go get a mortgage calculator. Go get an AM schedule. Figure it out. It's pretty cool stuff, actually. But those are the kind of things you learn. And, you may not know this stuff. I do. 25 years in this business. All kinds of different capacities. Obviously I've been around a while. Please feel free to call me, text me. My name is Paul, Blue Water Properties. I've lived here for most of my life, actually all my life, and I would love to work with you. Thank you very much.